As a lender, there's several ways to value commercial real estate: replacement value, income approach, and sales approach. I'm gonna go through these ways to keep it easy and simple, and more important, flexible for all of our clients. So you've probably heard of income approach, cap rate, pro forma, net operating income, things like that. So income approach is obviously a very popular way to value commercial real estate. You take your gross income, you minus out your expenses, and you have your NOI, your net operating income. And between that and a cap rate, you can determine what the value of a piece of real estate is. And although that's a good approach, when we value commercial real estate, it's a little bit more challenging than that to do so. That's a good way for a bank to value commercial real estate. We like doing things more on a sales approach. And by doing things on a sales approach, it's a lot more flexible and easy for our clients and our borrowers that we're lending money to. Because if you do a full income approach, comparison, you got to dig in very, very deep to all the financials, because it's really only worth that if it's performing perfectly. And different asset types and different real estate projects, depending on the type of building and the occupancy level, vary a lot, right? And that's why a lot of banks and institutional backed lenders have a hard time in the small commercial balance space. Some of the bigger projects with longer term tenants, that makes it a lot easier. But a lot of banks and institutional capital doesn't want to mess with the smaller multifamily projects, retail, professional office, mixed use, industrial, and self-storage stuff, because it's inconsistent when you have a smaller property, a small balance building with shorter term tenants, right? In essence, there's more risk, and it's hard to substantiate and determine exactly what that value of the property is. So as a commercial lender and a private lender ourselves, we look more on the sales approach and the income approach. And I get it, the income approach is important, the actual data and the pro forma data of how well it can operate. But again, that's more of a banking way to determine the value. And it's just harder for a bank to lend on that. And, for us, it's just easier to go through a sales approach, and it's just a lot more flexible, to do so. So internally, the way that we value commercial properties is more on a sales comparable approach, right? And some properties are easier to determine that than others, and I get it. But, we're not valuing the business that's operating it. It can be an owner-operator building. It can be a complete rental property building. We're worried about the real estate, the value of that real estate on a sales approach, meaning, comparables approach. You go out and you look at other buildings. Let's say it's a multifamily building, or let's say it's a retail building, right? And it's 2,000 square feet. We're going to go and we're going to try to find like-kind buildings and see where they traded, see what values they got in those. Although we do underwrite and look at building financials if they are operational, meaning if they have tenants in there. But, for the most part, and that's a bonus if they do, and we could potentially get higher leverage. But for the most part, we look at, hey, if this building is completely vacant, what would it trade for an owner-operator business or a tenant-operator business? And again, it depends on the building type, but those are all things to look for. Obviously, we all want long-term leases, good, trophy assets and tenants that are in place, but that's not always the case, especially in the small balance world, right? You might have an office building with a few units and a few professional tenants. When I say professional tenants, they're not signing 30-year leases or 20-year leases. They might be signing anywhere between a 2 and a 5-year lease, right? Banks don't really want to mess with that stuff. Banks want to lend on bigger stuff with longer term tenants. Private lenders are willing to do shorter term tenant stuff, right? And the reason is they're not just basing this off of, the actual income that's coming in from the property. They're basing this more on what's the resale on this thing? What can we fire sale this thing for? Typically, private lenders, including ourselves, will lend maybe 50 to 65% of the value of the building. Most are not going to do construction, or not going to take any emphasis in the tenant improvements, right? They're going to say, what is the as-is value of this property? And we can lend a bridge loan, a short-term loan on this. After the building's stabilized, potentially has longer-term tenants in place, then maybe a bank or an institution is the proper play after that. So the due diligence that a private lender would do is obviously a lot more lax than a potential bank or an institution. Profit and loss statement, maybe a balance sheet, maybe tax returns, but usually not all that necessary. Sometimes pro forma data based on what the plan is with new tenants or how it's going to work with some of the existing tenants. Rent rolls, leases, obviously longer the term, the leases, the better, but that's all right. Some sort of like abbreviated valuation. They're not going to get a full blown out MAI appraisal that's costs lots and lots of money. If you're a real estate owner of a commercial piece of property and it's, let's say you're looking for a $500,000 loan, like you can't support $20,000 or $25,000 in due diligence that bank might need you to get, right? So you get some sort of abbreviated valuation that we'll potentially get. We'll do some sort of abbreviated environmental. We won't go and get full blown out phase ones or phase two environmental studies. I mean, phase one environmental study might be $2,500, but phase two could be tons of money and would prohibit the deal from going through completely. Now, what we'll do is we'll get an environmental report that's typically $500, takes a few business days, and determines if there's any red flags. Like if it was previously used as a gas station, probably have to get a full phase one environmental, right? So that might take another 2 weeks and another $2,500. But we try to do it so it's reasonable in cost. Typical due diligence costs up front for a commercial deal, might only be $1,000 or $1,500, and on a bank or an institutional lender, it might be $10,000 or even more. So it makes it significantly more doable. And sometimes, depending on the project, there might be a zoning report to make sure you're able to get what you want out of that project. And with all of our commercial loans, just like our residential loans, and I think any private lender you're going to is probably similar, they're going to look at the collateral, make sure that's strong. They're going to look at the character to make sure the characteristics of the borrower are good. Do they have the capacity to execute? And do they have a credit score that they can exit? If it's a real estate investor buying a commercial property and they don't have good credit, that makes it challenging because most real estate investors aren't just going to flip, commercial assets. It's not like you're buying an office building just to potentially flip it a few months later, like a residential property. Not saying it's not possible, but usually the goal is a longer term play, put tenants in there, cash flow it, or put your business in there and operate it. And because most private money is used for shorter term purposes, there has to be some sort of exit strategy. An exit strategy can be a sale, exit strategy can be a refinance. But if it's a refinance, banks are going to want good credit in order to do so. That's how we value commercial real estate. That's how we underwrite deals for commercial real estate investors. We do a lot of small balance commercial properties and projects for real estate investors and commercial property owners all over the areas, not just local, but out of state as well. It's a good niche for us as a private lender. It's a good product available for, real estate investors that potentially, need to either purchase or refinance an existing commercial building, a commercial asset. They might not be bankable, not because they don't have good financials personally and good credit. The building might just not be financeable at this point. And it's harder for banks to do small balance commercial stuff. Sometimes they don't want to mess with it because the additional due diligence. SBA might be taking too long. A lot of loans that we do, are in underwriting with SBA and they're just taking too long and they're going to lose big deposits. So they'd rather spend 13% interest rate or whatever in order to get a private loan first, and then they can go to SBA. Hopefully you found this video helpful. If you have any questions related to this topic or any other topic on investing in residential or commercial properties, comment below. I personally go through all those. I appreciate it. If you enjoyed this video and you have any questions, like, comment, share, anything I can help you with, happy to help. Jason@hardmoneybankers.com.